Let's get a sense of what is the situation today likely to be, especially after we got that long-awaited interview of Urjit Patel with the PTI. And of course, to be fair, Piyush Goyal spoke to Shireen Bhan as well, and we'll play that bite for you in a bit. Basically, what Urjit Patel said is that they are waiting for the MSS bond permission to come from government, and at that time, they will review this massive CRR 100% hike that they have announced. Ananth Narayan, the Managing Director and Head of Trading at Standard Chartered Bank, and Suresh Ganapathy, the analyst who tracks banks very closely at Macquarie Capital Securities, are joining us on the phone line. Ananth, some water has flowed between your speaking to me yesterday and now. Patel has said that he's waiting for the MSS bonds permission to come through from the government. Now, do you think the bond markets need not worry much?
Morning, Lata. Yes, I think the words that came in from Dr. Patel were very timely. Given that they clarified the reason why RBI chose CRR was they didn't have clarity on the MSS yet. And he has, in effect, promised to, replace the CRR with MSS as and when that tool becomes available once the government sorts the issues out. I think the market now will operate under the assumption that the market will continue to remain under liquidity excess, that we don't have any more shocks coming in terms of more CRR hikes accompanied by parallel MSS issuances as well. So the long-standing April liquidity framework of liquidity neutrality is no longer valid. The market will assume that we will remain on liquidity surplus for a while now. And that, if you combine with everything else which is going around in the system, i.e. you have a lack of credit offtake, there is a definite slowdown for this quarter in terms of economic activity. There is surplus deposits lying with banks which will chase bonds and assets. And of course, the overall context on inflation, etc., which we will get as a result of the slowdown. It does make for bullish signal for bonds. You might see a bit of a correction today to start with. That correction could be a lot less than what we'd expected 24 hours ago, maybe 5 or 10 basis points, but that should be short-lived. Okay. And you should see people jumping and using this opportunity to actually buy up more bonds as and when there's a correction.
Okay, Ananth, good morning. So you're saying that there's no way that Indian bonds are in a bubble, and in fact, yields would head lower and they would be buying maybe today and tomorrow.
Yeah, Anuj, purely from a demand-supply perspective, there will be demand for bonds. If you have so much of deposit accretion happening to banks, and if you have liquidity remaining in substantial surplus, let's not forget that we are going to see liquidity increase over the next few days as well as fresh old currency notes come into the system. And given that there is a lack of deployment avenues, irrespective of what the underlying economic fundamentals look like, there is going to be a demand for bonds. Now, if this is indeed short-term, of course, there will be a demand for short-term bonds rather than the 10-year or 30-year bond. But nevertheless, across the board, we will see a demand coming through. I think what will be really useful from my perspective is a clarification, perhaps at the trade policy date, that we have moved away from the paradigm of liquidity neutrality to one of now surplus to continue for a while. And that is the operating assumption under which bonds will continue to rally.
Okay. We also have Suresh Ganapathy who joins in to give us his view on what this would do to banks, at least this morning. Suresh, hi, good morning. Once the MSS bonds come into play, then the CRR move may be retracted. But up until then, what do you see as the very near-term impact on banks, both PSU and private?
Yeah, sure. Sonia, look, the impact both on the positive as well as on the negative side is getting exaggerated in my view. Anyways, these CASA deposits which came into the banks as per SBI chairperson, 90% was anyway supposed to go out. So clearly the market was unnecessarily euphoric on some of these public sector banks. And now what's happened is that at the margin, clearly the liquidity gets impacted, and of course the PSU banks deposits, or rather the entire banking system deposits to the extent of 3.5 lakh crore needs to be parked with the RBI. But remember that the impact which we were floating around in CNBC at around 18,000, 19,000 crores is the annual impact. That is 6% on 3 lakh crore, assuming the entire 6% is paid over the year. The problem here is this is only going to be a momentary impact of a month or so. So in that sense, the eventual impact, if you divide by 12, is only 1,500 crores per month. So the impact actually is pretty limited and not very significant the way people are getting carried away looking at this particular measure. So in my view, yes, at the margin it is negative, but then it is not hugely negative as some people portray it out to be.
Okay. So, Suresh, if you have to, separate it out, would the impact be a little more on banks like, say, Kotak? Yes. I mean, banks which were raising a lot of money at 6% and had very little savings impact, if you have to look at the near-term impact.
No, so look, Lata, what's happened is that money is fungible. So if you look at it, some people argue they would have raised money at 7%. Those would be the FD rates when they raised in September. But at the end of the day, a couple of weeks later, when you have to maintain the balance, you would have anyways landed up getting 7 lakh crore or 8 lakh crore or 9 lakh crore. So that money anyways, which was anyway supposed to be deployed under the reverse repo or for that matter government securities, gets transferred to the RBI at no interest cost. So I don't think we can differentiate between privates getting more impacted or public sector banks getting more impacted. The liquidity is going to be abundant both in public as well as private sector banks. The impact from a stock price perspective could be more on public sector banks than private sector banks because the public sector banks had rallied 15% post demonetization. So to that extent, there has to be some correction in them because of this negative development.
Suresh, good morning. That was my next question actually. The PSU bank rally, the only sector which has rallied post demonetization.
Yeah.
Do you see that coming to a halt completely, or do you think maybe after 2 or 3 day hiccup that rally would resume?
No, so if you look at it in the interim, clearly there is expected to be a correction or other the rally coming to a halt, and perhaps you can see 10 to 15% correction in public sector banks, in my opinion, over the course of next 1 month or so. And remember, this is not only because of the RBI move; it is also because of the fact that the market will realize in couple of months' time that majority of these deposits are not sustainable and they are going to go out from the system, right? So clearly, the eventual benefits that is going to accrue to the system is going to be far lower than what the market had earlier anticipated. So to that extent, clearly the 15% move should be retraced, in my opinion, in a couple of months' time.
Okay, Ananth, if the RBI does extend these measures beyond the 9th of December, how much do you think that could limit the transmission of rates or the further cut in lending rates by banks?
Sonia, look, anything which is drawn out by way of CRR clearly impedes transmission. Of course, as a banker, I'm biased in this whole process, simply because the rate that you get is zero. And to the extent that whatever cost you've raised the deposit I add goes to the RBI and gets deployed at zero, it adds to the overall cost of funds for the bank and therefore for its clients. To the extent that CRR gets replaced by MSS, there is definite relief, because you do start to earn at least market bond yields for the extent of the MSS deployment. What we are hoping for is, yes, there could be more measures required, particularly as you see more deposits accruing till the end of December. What we are hoping is these will be in the form of MSS, and these will be in the form of MSS replacing CRR, with the overall liquidity remaining in excess, in which case transmission should continue reasonably well. As it is, banks are going around looking for clients to lend money to, given that they are sitting with surplus cash at the moment.
Okay. Ananth, you may be biased, but you are not alone. Yesterday, if you heard Mrs. Bhattacharya and Srini saying 100 times that CRR is an instrument which will, prevent them from passing on the rate cuts, certainly on the lending side. So clearly, that move will be there. If money is taken out, it's not going to be yet transmitted. But now we have to work with the assumption that this is a temporary measure. Let's leave it at that. Suresh and Ananth, thank you very much for joining in the morning and clarifying